Palantir's second quarter earnings just landed. Revenue grew 93%, the fastest it has ever grown in 20 years of trying. And the stock is still down for the year. That is not a small company doing it off a tiny base. This is a business that will book more than $8 billion this year, and it is speeding up, which is the one thing companies that size are not supposed to be able to do. And yet, anybody who bought this stock on New Year's Day is sitting on a loss of about 29%, which is a strange way to get paid for owning the fastest growing thing on the board. Well, here's the part that does not fit. The growth rate has gone up every single quarter for 2 years. 30%, then 36, 39, 48, 63, 70, 85, and now 93. And across that exact same stretch, the market took about a third off the price. So the better this company got at the thing it actually does, the less anybody was willing to pay for it. Palantir went into tonight with US commercial revenue compounding at 149%, a Rule of 40 score of 155, $9.2 billion in cash, no debt whatsoever, a net dollar retention rate of 157%, a record $2.1 billion of American commercial contracts signed inside 90 days, a Pentagon platform that Reuters says is on its way to becoming a program of record, and a share price 39% below where it sat in November. So did everybody spend 7 months mispricing the fastest growing large company on the exchange? Or has the price been telling us something the growth rate cannot? Revenue came in ahead of guidance, the stock went up 12%, so the quarter is a win and there is nothing left to argue about, right? Well, the beat itself is almost the least interesting number here. Back in May, Palantir's own guidance said Q2 revenue would land between $1.797 billion and $1.801 billion. It came in at $1.935 billion. That is $136 million past the midpoint of the company's own forecast, or about 7.5%. Published estimates were sitting around $1.8 billion, and CNBC had adjusted earnings penciled in at 35 cents. Palantir delivered 41. But here is the number that actually matters, and it is one that nobody puts in a headline. That guidance midpoint implied about 79% year-over-year growth. Palantir did 93. Its own management 3 months ago, with the quarter already 1 month old and every signed contract sitting in front of them, undershot their own business by nearly 14 percentage points. Palantir's guidance department appears to have exactly one job, and it is to be wrong in the same direction every 90 days. And this is not a company that got lucky in one quarter. Flip to the reconciliation page at the back of Palantir's own deck, and the year-over-year growth column reads 30, 36, 39, 48, 63, 70, 85, 93. 8 quarters in a row of accelerating growth. At that point, it stops being a streak and becomes a personality trait. Sequentially, the business grew 19% in 90 days, and it did that off the largest base it has ever had, which is the part that makes the acceleration real rather than arithmetic. So, that is the answer to, did they beat? Well, sort of. Beating your own guidance mostly proves that you guided low in May, and a backward-looking quarter tells us what already happened to a business that everybody already agreed was growing. It tells us almost nothing about the argument the market has actually been having with this stock all year. The standard objection to Palantir is that it is a defense contractor wearing an AI sticker on the front, and that the commercial story is a slide deck, right? Well, this quarter is genuinely awkward for that. US government revenue grew 90% to $809 million. US commercial revenue grew 149% to $764 million. Commercial is now within $45 million of the government business that everybody thinks is the whole company, and it is growing at nearly twice the rate. Both engines ran. That is the honest read. And the bookings back it up rather than contradicting it. 220 deals over $1 million, 98 over $5 million, 73 over $10 million. Last quarter, the $10 million column was 47. Net dollar retention hit 157%, up from 150. Existing customers spent 57% more than they did a year ago, which is the single hardest number in this entire release to argue with, because it has nothing to do with the sales pitch and everything to do with whether the software worked. So here's the part I had to work out myself, because Palantir did not put it on a slide for reasons I invite you to speculate about. Total contract value across the whole company grew 49% to $3.37 billion. U.S. commercial contract value grew 153% to a record $2.13 billion. Subtract one from the other, do the same for last year, and everything that is not American commercial, the government business, the whole international book, all of it, signed about $1.24 billion of new contracts this quarter, against roughly $1.42 billion a year ago. That is down about 13%. That is our arithmetic, not a Palantir disclosure, and both inputs are Palantir's own numbers. But it means the record was one engine, not two. So is the international business actually breaking, or is it just being buried by how fast America is growing? A bit of both, I think, and the geography makes it visible. International revenue grew 34%, which in almost any other company is a good year. Here it means international fell from 27% of the business to under 19% in 12 months. Of the $932 million of revenue Palantir added year over year, 90% of it came from the United States. Karp's letter opens by announcing a global movement. The income statement is about America, with a polite nod to everybody else. So the business is compounding faster than it ever has in the one geography that pays the most, and the stock spent 7 months going the other way. Something in this picture is wrong, and it is either the company or the price. So let's run the numbers and find out which one the market has actually been arguing with. The cynical version of Palantir is that it is a very good data integration company with a very quotable CEO, and that AI sovereignty is a phrase invented to make enterprise plumbing sound like a cause. There is a real argument underneath it, though, and it is a pricing argument, which is the only kind I trust. Karp's letter says, and I am quoting, "We do not get paid for clicks or tokens or chats." The claim is that Palantir charges as a share of value created rather than volume consumed, which sounds like marketing, until you notice it makes a specific, falsifiable prediction. If you get paid on outcomes, your customers should keep expanding whether or not they use you more. Net dollar retention of 157% is that prediction coming true. Adjusted gross margin of 86% says the delivery is software, not consultants in a trench coat. And sales and marketing expense grew 39%, while revenue grew 93%. Karp claims that was achieved with what he calls a minuscule and shrinking sales headcount. And Palantir does not publish sales headcount, so I cannot check that directly. But the expense line is consistent with it, and the expense line is audited. The deck then does what these decks always do, which is wheel out the customers. A law firm putting its fundraising tradecraft into a platform. SAP embedding Palantir across its migration toolchain. Centrus trying to rebuild American uranium enrichment, whose chief executive says they have identified nearly $300 million of savings so far. The USDA, which pushed $4.4 billion to farmers in the first 5 days of a program. And every single one of those numbers comes from a customer, quoted in a deck, published by the company those customers are paying. I am not saying any of it is false. I am saying that nobody independent is auditing the phrase value opportunity, and that a business model built on being the alternative to the frontier labs is a bet on how the next 5 years go, not a fact about how the last 90 days went. Sovereignty is a thesis. This quarter is not evidence for it. It is just $1 billion of profit at a 62% adjusted operating margin settles the old argument about whether Palantir's software economics work, right?
Mostly, yes. And I want to give this its due before I complicate it. GAAP operating income, no adjustments, no add-backs, the number the auditors sign was $912 million, a 47% margin. The adjusted figure is $1.19 billion at 62. The bridge between them is $265 million of stock compensation and $17 million of payroll tax on it. And the usual complaint about that bridge is weaker this quarter than it has been in years. Stock compensation grew 66% while revenue grew 93%, so it fell from about 16% of revenue to under 14%. The diluted share count went up by 0.23%. Whatever Palantir is doing to shareholders through stock comp, it did less of it this quarter than last. Adjusted free cash flow was $1.22 billion at a 63% margin, and they finished with $9.2 billion in cash and no debt at all. So here is where I want to slow down, because there is one thing in this release that nobody is going to mention on television. Net income was $1.06 billion, but Palantir's provision for income taxes was $15.4 million on $1.08 billion of pre-tax income. That is an effective tax rate of 1.4%, And below the operating line, there is $77 million of interest income and $92 million of other income, which together are about 16% of pre-tax profit earned by the balance sheet rather than by the business. Normalize the tax rate to the 23% that Palantir itself uses in its own footnote, and adjusted net income comes out at $1.047 billion, below GAAP net income of $1.062 billion. GAAP earnings per share and adjusted earnings per share are both 41 cents. This is the rare quarter where the adjusted number is the more conservative one, which for a software company is a bit like discovering the marketing department rounded down. Which brings us back to the only question that has actually mattered all year. If the business did all of that, why has this stock been falling since November? Well, run it. On the 31st of December, Palantir closed at $177.75. On the diluted share count in this release, that is about $457 billion of market value, roughly 56 times the full-year revenue the company is now guiding to. On Monday afternoon, before any of this came out, it closed at $125.65. Same share count, that is about $323 billion, or 39.6 times. So while the growth rate climbed from 70% to 85 to 93, the multiple fell from 56 times sales to under 40. The stock did not fall because the business got worse. It fell because the price people were willing to pay for each dollar of that business got cut by roughly a third, which is a completely different thing, and it is the entire story of Palantir in 2026. And then tonight happened. The stock jumped to $141.29 within the hour, up 12.5%, and then it just sat there. An hour later, with the earnings call winding down, it was still trading around 140. That is roughly $38 billion of market value created in about 2 hours, which is close to 5 times everything Palantir expects to sell in the entire year. Now, the first move after a release reverses often enough that I would normally tell you to ignore it completely. This one has not reversed. It has also only been 2 hours, so hold that lightly. But look at what the move actually did. The full-year revenue guide went up 6.5%. The stock went up almost 12. The multiple went from 39.6 times sales back up to about 44. The market did not just accept the new numbers, it paid more per dollar of them than it had that morning. And here is the test I keep coming back to. At $363 billion, for this to become 20 times sales by 2030 without the share price falling a cent, Palantir has to get to roughly $18 billion of revenue. From 8.15 this year, that is a 22% compound growth rate for 4 straight years. And I want to flag that 20 times is a benchmark I picked, not a law of nature. For a company that just did 93, 22% a year sounds trivial. Palantir's own guidance already implies it slows to 83% next quarter and around 72 in the fourth. Those are the first guided decelerations in this whole run, and they came from the same people who undershot by 14 points in May. The strongest thing in this report is not the 93%, it is the 157% retention, because that is customers voting with a renewal rather than analysts voting with a model. The weakest thing is the one nobody will print. Outside American commercial, Palantir's bookings went backwards this quarter. And I might be completely wrong about which of those matters more. Valuation has never once told anybody when. It only tells you how much you are paying to find out. And a stock that is already 39% below its high is not obviously the one that is mispriced. The market spent 7 months arguing that 93% growth was worth less per dollar than 70% growth was. Tonight, it changed its mind by about a third of the way. Neither of those is the same as being right. Hit subscribe so we can keep running the numbers.